Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world's secrets. Today we're diving into Blackstone Secured Lending Fund's recent filing. Was this report a home run? Let's find out. This report sheds light on the company's operations and financial health. We're going to simplify some complex information. If you dig deep dives into financial documents, make sure to subscribe. We also have a Discord community linked in the description below where you can share your own opinions. So what is this report anyway? It's a prospectus supplement which updates the information contained in a previous prospectus. Think of it as an update that tells investors about a specific offering of stock. Blackstone has entered into agreements with several sales agents like Truist Securities and RBC Capital Markets. They might sell up to $600 million worth of common share stock. This is an at-the-market offering, which means they'll sell shares at the current market price. Blackstone Secured Lending Fund is a business development company, or BDC. They loan money to private US companies. The goal? Generate income and some long-term capital growth. They're regulated under the Investment Company Act of 1940. They elect to be treated as a Regulated Investment Company Act of 1940. They elect to be treated as a regulator as a RESI. Their main goals are to make money for investors now through generating income and a smaller extent from investment returns later. They aim to achieve these goals by using the expertise of their advisors, focusing on loans to middle and large market US companies. They also seek investments that provide principal protection and operational benefits to improve portfolio companies. They primarily invest in secured loans. They may also invest a smaller portion in riskier debt or equity. They avoid companies in distress, but they may invest in the loans that benefit other Blackstone funds. Now, a word of caution. This document contains forward-looking statements. These are based on current expectations and are not guarantees of future results. Many factors could cause actual results to differ. We should not rely on the document as a representation by the company that our plans and objectives will be achieved. Let's talk about the fees. Sales loads are estimated at 1.00% and offering expenses are around a 0% that are made up of management fees, incentive fees and interest on borrowed funds. All of the above can add up to 11.03% of net assets, which sounds really high. Always keep these numbers and expenses estimates in mind before making any investment decisions. Let's look at what this means in real numbers. Say you invest $1,000. After 1 year, and assuming that the performance results entirely from net investment income, you might pay $94 in transaction expenses. If it's from net realized capital gains, you may pay $11.71 expenses. In 10 years, the estimates go up to $721 through and $80.24 accordingly. The money from selling shares will be used for general corporate purposes. This can include investing in more companies and paying down debt. Note that some sales agents are also lenders to Blackstone, so they might benefit from this offering. Their common shares trade on the New York Stock Exchange under the ticker BXS. On July 10, 2025, the last recorded closing sale was $31.56. The net asset value per share at the end of March 2025 was $27.29. Now, let's get fiscal. Here are some selected numbers that compare the 3 months ended March 31, 2025 against the year 2024. Total return based on NAV was 2.8% for the recent quarter against the 13.7% of the previous year. The total return based on market value was 2.6% compared to 29.8%. Ratio of net expenses to net average assets was 10.5% versus 11.2%, a sign that the team is getting more frugal over expenses, potentially indicating strong financial management. The report also talks about how investment opportunities are sourced. They look for companies with leading market positions, proven management, and private equity sponsorship. Blackstone Credit and Insurance also has a value creation program to offer expertise to its portfolio. When identifying prospective investment opportunities, the advisors currently intend to rely on fundamental credit analysis in order to minimize the loss of the company's capital, which is always a good thing, but doesn't necessarily offer that much upside outside of minimizing risk and potential opportunity cost. Now, if you're curious about who they're investing in, you can scroll down to the portfolio companies. They have different types of credit. Equity in companies across various sector. The fund is ultimately managed by Blackstone Private Credit Strategies and is supported by Blackstone Credit BDC advisors. The fund's senior and financial information can be found on its most recent 10Q report. The numbers are for the quarter ended March 31, 2025, and compared to the fund performance as of the full year of 2024 SOF. Now, what are my overall impressions of this information? With their scale and credit investment strategy, Blackstone Credit is looking good. The increasing demand for private credit certainly helps. Now for risks, the fund might struggle if interest rates rise significantly or if there are defaults in its portfolio. I'd say this fund could work for investors seeking income, but just remember, do your own research and speak with a financial advisor. Alright, that's our dive into Blackstone Secured Lending Fund's recent filing. What's your take on these numbers? Share your thoughts in the comments section below. If you found this analysis valuable, please like this video and subscribe for more deep dives. Also, don't forget to check out our Discord server in the description. Thanks for tuning in.